Massive liquidity is being injected into the system, and while that might sound technical or distant, its implications are real, far-reaching, and deeply consequential. We're in a period where monetary authorities around the world are engaging in coordinated and aggressive policies to stimulate economic growth. But what's important to understand is that this isn't simply about managing recessions or smoothing out short-term volatility. This is about responding to long-term structural imbalances that have been building for decades, imbalances involving debt, demographics, productivity, and political pressure. When countries accumulate too much debt that can no longer be paid back through normal economic growth, the options become limited. They can default outright, which causes political and social unrest. They can raise taxes significantly, which slows growth, or they can take the path that history shows is most commonly chosen. They can print money, and that's exactly what we're seeing now, but it's not called printing money anymore. It's called quantitative easing, liquidity operations, or balance sheet expansion. Whatever the label, the effect is the same. Central banks are creating money out of thin air and using it to buy financial assets, especially government bonds. This activity creates a cascade effect throughout the financial system. Interest rates are pushed lower across the board, which is precisely the goal. Lower rates make borrowing cheaper, which incentivizes more debt. They also reduce the attractiveness of holding cash, which drives investors further out on the risk curve, into equities, into real estate, into speculative assets. So asset prices rise. On paper, this looks like prosperity. Markets go up, wealth increases, at least for those who own assets, but it's important to distinguish between nominal increases in wealth and real gains in productivity or income. That distinction is being blurred in today's environment, and that's where the risk lies. When there's more money chasing the same amount of goods and services, prices rise. That's inflation, and it's already working its way into the system in both visible and hidden ways. In traditional terms, you might not see hyperinflation. You might not see double-digit CPI numbers, but you will see a loss of purchasing power in more subtle, persistent forms. The cost of buying a home, sending a child to college, or retiring with dignity, those are all becoming more expensive relative to income. And that's what matters. The problem with injecting large amounts of liquidity is that it doesn't solve the underlying structural issues. It merely paper over them. It's like giving morphine to someone with a broken leg. It relieves the pain, but it doesn't heal the fracture. Economies need productivity growth, innovation, and effective capital allocation to thrive in the long term. But when money becomes abundant and nearly free, capital is no longer allocated efficiently. Malinvestment creeps in. Zombie companies are kept alive by cheap credit. Risk-taking becomes distorted, and financial markets become increasingly disconnected from real economic fundamentals. Moreover, there's a distributional effect to all of this. The people who benefit most from liquidity injections are those who already have financial assets. Stocks go up, bond yields fall, raising the price of existing debt. Real estate appreciates. This creates a widening gap between those who own assets and those who live paycheck to paycheck. It increases inequality, not just in wealth, but in opportunity and security. Over time, that leads to political backlash. You see populism rise, institutions come under pressure, social contracts begin to erode. It's also important to consider the psychological consequences of massive liquidity. When people begin to believe that central banks will always step in to prevent losses, that they'll always stimulate, always inject more money, then moral hazard increases, risk becomes mispriced. Market participants act not based on fundamentals, but on expectations of policy intervention. That's a dangerous environment because it builds fragility into the system. The longer the illusion of stability persists, the more violent the adjustment tends to be when confidence eventually breaks. So what we're seeing today is not new. It's part of a long-term cycle. Monetary policy is being used to deal with problems that fiscal policy can't solve, and structural reforms that politics won't address. But there's a limit to how far this can go. Money creation can support asset prices and growth for a while, but it cannot create real wealth. Real wealth comes from productivity, producing more goods and services per unit of input. If we lose sight of that, we confuse financial engineering with real progress. Understanding this environment requires stepping back and seeing the full picture. The system we're in now is not sustainable forever. It's a phase, and like all phases in history, it will end. The question isn't whether liquidity will stop being injected. The question is how the system will evolve as a result of it, and whether you're positioned accordingly. Most people look at rising prices, whether it's in housing, equities, or even collectibles, and feel a sense of wealth or optimism. But that perception is often disconnected from reality. When asset prices rise significantly faster than income or productivity, what we're witnessing isn't real wealth creation. It's the result of more money and credit chasing a limited number of desirable assets. That distinction is critical to understand because confusing the two leads to poor decisions, both at the personal and policy level. Real productivity growth is what drives sustainable wealth. It happens when we produce more goods and services with the same or fewer inputs, whether that's labor, capital, or technology. It's the engine of long-term prosperity. In contrast, asset inflation is driven by liquidity, by money creation, low interest rates, and leverage. It creates the illusion of prosperity because numbers on a screen go up, portfolios look healthier, and net worth rises. But that illusion is fragile, and it's entirely dependent on the flow of cheap money continuing. The problem is when central banks make money cheap and abundant, as they've been doing for years, they're not creating value. They're distorting the pricing mechanism that allocates resources. In a normal environment, capital flows to the most productive uses. In a distorted environment, it flows to the most financially engineered ones. You get companies that can survive only because credit is free, business models that work only because investors are desperate for yield, and speculative assets that rise simply because people expect others to buy them at a higher price. That's not sustainable. At some point, either the money printing has to stop, or the system has to reset through inflation, default, or a loss of confidence. And history shows that once this kind of asset inflation cycle begins, it tends to go further than most people expect, and ends more abruptly than anyone is prepared for. In periods like this, people start to confuse rising asset prices with economic health. They see a booming stock market and assume it means the economy is strong, but in many cases, the opposite is true. The market is rising precisely because the economy is weak and central banks are stepping in with massive liquidity. That creates a divergence between financial assets and real productivity. Over time, this divergence becomes a problem. Why? Because you can't eat stock gains. You can't retire on inflated home prices if your income hasn't grown. And you can't run a society where asset holders get richer by doing nothing, while wage earners fall further behind despite working harder. That imbalance eventually causes stress, economically, politically, and socially. Another dangerous consequence of asset inflation is complacency. When people see their wealth rising on paper, they feel secure. They spend more, take on more risk, and plan for a future that assumes the trend will continue. But if the foundation of that trend is simply more credit and more money, not more productivity, then it's unstable. All it takes is a shift in confidence, a policy mistake, or a tightening of liquidity, and the entire structure begins to wobble. That's why cycles matter. Economies and markets operate in long-term debt cycles and short-term business cycles. When we're late in the long-term debt cycle, as we are now, asset inflation tends to accelerate, central banks tend to become more aggressive, and people tend to underestimate the risks. But eventually, the cycle turns, and when it does, those who understood the difference between productivity-driven growth and liquidity-driven asset inflation are the ones who preserve their capital and often expand it. It's also worth remembering that wealth isn't what you see on a statement. Real wealth is the capacity to sustain and improve living standards over time. It comes from innovation, efficiency, education, infrastructure, things that take time, planning, and investment. Simply pumping money into the system does not achieve that. It may provide a bridge over short-term distress, but it can't replace the hard work of building a productive economy. So the key is not to be distracted by inflated numbers or rising charts. The key is to look deeper. Ask, is this driven by true value creation or by financial manipulation? Is this a bubble inflated by liquidity or a real trend backed by innovation and output? Those who can answer those questions honestly and act accordingly will be in a much stronger position when the tide inevitably shifts, because it always does. What's happening now isn't new. It's just not obvious to most people because it's not playing out with sirens or headlines. It's unfolding quietly, systematically, and in a way that history has shown time and time again. When central banks flood the economy with money and governments run persistent deficits financed by printing, there is always a consequence. That consequence is a shift in who owns real wealth and who loses it. The wealth transfer is already underway. This kind of transfer doesn't happen overnight. It builds slowly, like a leak in the foundation. At first, everything feels fine. In fact, many people feel richer. Their home values go up, their portfolios expand, the market looks strong, but under the surface, purchasing power is being eroded. The money in your pocket, your savings account, or your fixed income investments, those are all gradually losing value relative to the things you actually need to buy to live well. That's how the transfer happens. It's not through a vote or a law, it's through the silent erosion of the value of money. Those who understand how the financial system works have already moved. They've allocated out of cash and into real assets, things that can't be printed. They've rebalanced into diversified global portfolios, inflation, hedged instruments, and income-producing vehicles that adjust with economic shifts. They're not waiting for official statistics to tell them inflation is rising. They're looking at the mechanics behind the scenes, the money supply growth, the real interest rates, the direction of debt and productivity. On the other hand, there's a large portion of the population that is sitting still. They're doing what used to work, saving in cash, buying long duration bonds, holding on to a fixed income, but the environment has changed. The rules that worked in the last cycle are no longer valid in this one. And that's what makes this kind of wealth transfer especially dangerous. It rewards those who are financially literate and globally aware, while penalizing those who simply trust the system to protect them. When you look back through history, whether it's post-World War periods, the 1970s, or emerging market debt crises, the pattern is consistent. Governments accumulate too much debt, and the easiest way out is to inflate it away. That means repaying obligations in devalued currency, not defaulting outright. And that process punishes holders of nominal assets, savers, pensioners, fixed-wage workers, while rewarding those who own assets that rise with inflation or who can adjust their income and investments dynamically. This is not just an economic shift, it's a societal one. As purchasing power diverges between those who hold real assets and those who don't, inequality rises. That fuels frustration, resentment, and eventually political backlash. You begin to see polarization, populism, and pressure on institutions. The economy becomes more fragile, not because of a lack of money, but because of a lack of trust in what that money actually means. What's important to understand is that this isn't a moral judgment. It's not about fairness. It's about mechanics. If you inject trillions of dollars into an economy and hold interest rates below inflation, you will inevitably change who gains and who loses. Those who borrow at negative real rates and invest in appreciating assets come out ahead. Those who save and sit still fall behind. That's how the system rebalances itself when traditional tools are exhausted. We are in the late stage of a long-term debt cycle. In this stage, monetary policy becomes less effective, fiscal policy becomes more aggressive, and currencies become more volatile. Capital starts to move more quickly across borders, searching for yield and safety. And the distinctions between money, credit, and wealth become increasingly blurred. In that kind of environment, the biggest risk is inaction, staying in the same strategy simply because it feels familiar or safe. The people who will come out of this period stronger are the ones who recognize that the ground has already shifted. They're not reacting emotionally. They're thinking in terms of cycles, incentives, and global flows. They're diversified, not just geographically, but across asset classes, income sources, and risk exposures. They're preparing for a world where traditional assumptions about interest rates, inflation, growth no longer hold in the same way. This kind of environment doesn't reward prediction. It rewards preparation. And preparation means seeing that the transfer of wealth is not something that's coming. It's something that's already happening. Quietly, steadily, and irreversibly, you either adapt to it or you become its casualty. That choice is being made now, whether people realize it or not. If you study history objectively, looking past emotions, ideologies, and short-term narratives, you start to see patterns. Clear ones. Economic cycles, debt cycles, political cycles. They repeat, not in identical form, but in familiar rhythms. That's because they're rooted in human nature: fear, greed, power, competition. The specifics change, but the forces don't. And right now, those forces are pointing to something bigger than a routine downturn or a market correction. They're pointing to a paradigm shift, and cycles don't lie. A paradigm shift is when the assumptions that governed the last era stop working. It's when tools that used to stabilize the system start to lose their power. And it's when the relationship between money, value, and trust begins to break down. We're in that territory now. In the past few decades, the world has operated under a set of principles that felt reliable: free, flowing capital, central bank control over inflation, globalization creating efficiencies, and debt-fueled growth managed through interest rate policy. That was the framework, and for a while it worked. Standards of living rose, markets delivered strong returns, leverage amplified gains. The system was stable enough for people to trust it, and trust kept the system functioning. But that trust is eroding because the underlying fundamentals have changed, debt levels have become unsustainable, demographics have shifted, productivity growth has slowed, and the tools that worked in the old paradigm, like lowering interest rates or expanding credit, don't work the same way anymore. When rates are already near zero or negative, and when debt levels are so high that adding more creates diminishing returns, the old playbook becomes ineffective. At that point, the system begins transitioning, like it or not. One of the clearest signs of a paradigm shift is when money itself changes in meaning. When money can be created in virtually unlimited quantities without a corresponding increase in goods and services, its value becomes unstable. People begin to question what it's really worth. That's what leads to inflation, not just of prices, but of assets, of expectations, of uncertainty. And once that process begins, confidence becomes more important than policy. Because in the absence of trust, even the most sophisticated monetary tools lose their impact. We're also seeing geopolitical shifts that typically accompany the end of long-term cycles, rising powers challenging established ones, fragmentation of global trade, declining cooperation between nations. These are not isolated events. They're features of the late stages of a cycle when economic strain turns into political friction and national interests override global coordination. This is what history tells us to expect. We're not seeing anything unprecedented. We're seeing what always happens when a system reaches its limits. The natural instinct during times like these is to hold on to what worked in the past, to assume the next phase will look like the last one, just slower or bumpier. But that's a mistake. Paradigm shifts don't just bend the old model, they break it, and they force new behaviors. Investors, institutions, governments, they all have to adapt or risk being left behind by the new reality. One way to understand the scale of this shift is to look at the gap between asset prices and economic productivity. That gap is no longer marginal, it's historic. The rise in valuations isn't being driven by output or innovation, but by liquidity and expectation. That kind of gap always closes, either through a correction in prices or an acceleration in real growth. And given the structural limitations we're facing, the correction scenario is becoming more likely. But beyond markets, the shift is social and psychological. People are questioning the fairness of the system, the effectiveness of leadership, the legitimacy of institutions. These questions arise when long periods of stability lead to complacency and when imbalances go unaddressed for too long. The result is volatility, not just in prices, but in beliefs, behavior, and trust, and that's when the system becomes ripe for reinvention. Being in a paradigm shift doesn't mean doom, it means transition. But transitions are uncomfortable. They require new thinking, broader perspective, and a deeper understanding of history. You can't navigate a new era with old maps. You need to see the terrain clearly, not through the lens of hope or fear, but through understanding. Cycles are nature's way of rebalancing. They're inevitable and they're neutral. What matters is how you respond. If you accept that we're not in a temporary dislocation, but a structural turning point, you begin to position differently. You diversify, you prepare for volatility. You stop assuming mean reversion will save you, and you look for value in places others are overlooking. That's how people and institutions survive paradigm shifts. not by predicting every move, but by recognizing the shift itself. Because cycles don't lie. They simply reveal what's been building beneath the surface all along.